Assalamualaikum, my name is Nuriza Amani. So let me start with objective of the study. The main goal for this study is about financial ratio and analysis of Pharmaniaga Berhad. The objective of this study are to identify the performance of Pharmaniaga Berhad using financial ratio, providing information on an organization's economic resources, claims to those resources such as liabilities and honest equity, and how these resources and claims have changed over time. To provide information to various stakeholders about an organization's performance management in terms of how rigorously and ethically they are carrying out their fiduciary duties and responsibilities. Next, background of Pharmaniaga Berhad. Pharmaniaga's founder, Remedy Pharmaceuticals, was established in 1994. In August 1998, the company changed its name to Pharmaniaga and became the country's first healthcare provider to list on the Kuala Lumpur Stock Exchange main market, or Bursa Malaysia as it is now known. Pharmaniaga Berhad is extremely delighted to be Malaysia's largest integrated pharmaceutical firm. Because of their commitment to excellence, they have established a strong reputation as a provider of first-rate products and services within the healthcare industry. Community pharmacy, the production of generic pharmaceuticals, sales and marketing, the distribution of medical supplies and hospital equipment, and logistics and distribution are only a few of their business operations. The pharmaceutical and healthcare sectors in Malaysia have been established to the highest standards by Pharmaniaga Berhad, the first company to be listed on the main board of Bursa Malaysia. Pharmaniaga also has a significant and growing global reach. The company's motto is "Patient for Patients", and they consistently provide consumers with the best products and services. In order to realize its aim of being the preferred pharmaceutical brand in local markets, Pharmaniaga's mission is to provide top-notch product and great services via skilled, committed and caring employees. Next, we move to types of ratio. There are 5 types of ratio. First, liquidity ratio. Liquidity ratio is an important financial tool which assesses a debtor's capacity to settle outstanding obligations without raising outside funds. Second, activity ratio. A financial indicator known as the activity ratio shows how effectively a firm is using the assets on its balance sheet to produce revenue and cash. Third, leverage ratio. The amount of debt a business company has in relation to other accounts on its balance sheet, income statement or cash flow statement is compared using a financial ratio known as a leverage ratio. Next, profitability ratio. Profitability ratios can show how effectively a company's management manage the business. To determine if a firm is acceptable for investment, investors may utilize them in addition to other research. Last, market ratio. To compare the present price of the stock to the market price, the company truly utilize a market ratio. The company will then evaluate it in relation to its present rivals. My name is Zulaikha. So I will present about liquidity ratio and activity ratio. The calculation shows that Pharmaniaga current ratio is increasing from 0.78 times in 2020 to 1.10 times in 2021. However, the current ratio is expected to fall to 0.65 times in 2022. The greater the ratio, the better the company's performance because it demonstrates the firm's ability to satisfy short-term commitment as they come due and lowers the possibility of short-term solvency. The best year is 2021. Next is quick ratio. According to the calculation, Pharmaniaga quick ratio is decreasing from 0.28 times in 2020 to 0.24 times in 2021. Unfortunately, the quick ratio falls to 0.23 times in 2022, which is considered poor. The lower the ratio, the worse the company performance, as it shows a lesser ability to pay short-term commitment without having to rely on the sale of inventory and prepaid, which tend to be the least liquid of the current asset. This company greater years for quick ratio is 2020. Next, account receivable turnover. Pharmaniaga's account receivable turnover is increasing from 9.41 times in 2020 to 16.17 times in 2021. Therefore, in year 2022, the ratio is decreasing to 9.98 times from 16.17 times in 2021. Low turnover implies that a company's sales are poor. It is carrying too much inventory or experience poor inventory management. Unsold inventory can face significant risk from fluctuating market.
Next, Pharmaniaga's inventory turnover is decreasing from 4.41 time in 2020 to 3.31 time in 2021. Therefore, in year 2022, the ratio is increasing to 4.81 times from 3.31 times in 2021. Low turnover implies that the company sale or poor it is carrying too much inventory or experience poor inventory management. Unsold inventory can face significant risk from fluctuating market price and obsolescence.
My name is Shafika. Next is leverage ratio, which is debt ratio. The debt ratio increased from year to year minimally in 2020, 2021, and 2022. The debt ratio increased from 78% to 79% in 2021. In year 2022, the ratio was increased from 130 to 79% in 2021. Lower debt ratio indicate lower financial risk. The best debt ratio is in year 2020. Next is time interest. In this discussion, we realized that the more time interest is generated, the better since it helps determine a company's capacity to make its interest payment. An increase in this ratio from 2021 to 2022 for the Pharmaniaga Berhad company showed that it was paying interest at the rate of 338.29 times instead of 181.93 times. However, the Pharmaniaga Berhad company is not paying more interest in 2020 because its earnings have not decreased from the previous year. For this reason, we believe that the company is in the greatest possible position in terms of interest generated over time. Next is profitability ratio, gross profit margin. From the calculation in 2021, Pharmaniaga Berhad gross profit margin is 30.08%, which is higher than 10.83% compared to 2020 and show a better performance than year 2020 where Pharmaniaga Berhad can control its sales and cost of goods sold. Then, the gross profit margin decreased to negative 5.12% in year 2022, which is negative indicator. The corporation performed better the bigger its gross profits. Next is operating profit margin. In the year 2021, Pharmaniaga Berhad operating profit margin is 12.27, which is higher than 2.26% compared to year 2020. It shows that Pharmaniaga Berhad has a good performance in controlling revenues, cost of goods sold, and operating expenses compared to the year 2020. Unfortunately, in the year 2022, it dropped to negative 32%, and we can conclude that the company's running costs were out of control.
Hi, my name is Huna. I will present about market ratio. For EPS or earning per share in the year 2021, Pharmaniaga Berhad earning per share ratio is 30 ringgit 50 cent, higher than average compared to the year 2020. Which is RM 10 ringgit 51 cent. It is a good improvement in the performance compared to the year 2020. But in year 2022, Pharmaniaga Berhad decreased from 30 ringgit 50 cent in year 2021 to negative 56 ringgit 36 cent in 2022, as shown by the computation above. Low ratio indicated that the company is not profitable, meaning there is a lesser profit for the business to give to its owners. Next, let's move to the price to earning. In year 2021, Pharmaniaga Berhad price earning ratio is 0.06, which is below than average compared to the year 2020, which is 0.09. Then, in year 2022, also decreased to negative 0.01 than year before. This means that Pharmaniaga Berhad is not having growth and have a bad performance. That means that the investor is not willing to pay for every ringgit of film. In conclusion, financial manager and other interest parties rely on ratio analysis to find trend, strengths, and weaknesses of the organization. This will allow management to take necessary action to repair any weakness or strength. And the strength is to guarantee the frame goal of maximizing owner wealth is met. Although ratio analysis is useful, it has several limitations, particularly when employing an industry's average index. Liquidity ratio are one of the most important type of financial values used to estimate a debtor capacity to meet current debt obligation without raising external funds.